Coming up in today's show, the Dow on the longest winning streak since 2017. We get earnings results for Microsoft and Alphabet and a bunch of other companies as well. And the Fed's expected to hike rates tomorrow, take them to a 22-year high, and we'll see whether their guidance can stop the daily grind higher in the stock market. Hey, what's up guys? Welcome back to the Click Capital Daily Show. My name's Jared. I'm going to run you through all the most important news, data, and charts from the markets today. So hit that subscribe button if you haven't already, as I make these videos every day after close. And it looks like the daily grind higher continues, led by the Nasdaq today and mega cap tech and semiconductors in particular leading the way. We also saw a good pop up in the materials sector and a bit of softness in financials and healthcare. And the Dow Jones Industrials is on a bit of a tear here, closing high for the 11th day in a row now. And like I showed yesterday, this can be a sign of positive returns to come in the market, with history showing that we could expect outperformance in the next 6 to 12 months. And that's further confirmed by Dow theory as well, with the industrials and transport sector both recently hitting 52-week highs and confirming a bit of breadth out there in the market. And a lot of the rally this year is thanks to the AI hype kicked off by ChatGPT being launched late last year. And for some bullish arguments today, we've got none other than Fundstrat's Top Lee saying the AI-driven stock market bubble has not yet formed. And one of the reasons he gave was comparing Cisco from the late 90s initial internet tech bubble to that of NVDA today. And he pointed out from 1990 to 1997, $100 invested in Cisco turned into $11,500. And it's true, a lot of people were calling it a bubble back then and overvalued. And in the long run, they were right. However, what happened after 1997, going into late 1999, was that 11,500 then went completely parabolic and turned into 100,000. And in comparison of NVIDIA, the same multi-year period turned $100 into 8,800. And we can see that on this chart here. So this is an isolated example, and Cisco was crazy in the late 90s. However, like Tom Lee points out, NVIDIA is not that same level of craziness. Other reasons he believes a true bubble hasn't formed yet is 6 of the 8 mega cap tech stocks are still trading below their all-time highs. And lastly, the point he makes is fund flows into equities overall still aren't at bubble levels. Since the end of last year, investors have pulled out $115 million out of stocks for the cumulative equity flow. Finally, he says that's not a real definition of a bubble. My definition of a bubble is when your neighbor is making money on a stock and you are not. I do think it's very subjective. And that he's right about. You can look at 1,000 different indicators and you can just draw about any conclusion you want. And that's why trading and investing will always be part science and part art. Taking a look at another bullish argument out today is a research firm saying the US is headed for a roaring economic boom thanks to AI, robots, and quantum computers. President Yardeni Research thinks the US is headed for the roaring 20s, a decade of robust economic growth, and that cooling inflation will also help companies improve profit margins. He said, I think that by the end of the decade, we'll look back on it and say it started out awful but ended up awfully good. And who's to say he's wrong? He could actually be right. If AI does allow a lot of companies to make their businesses more efficient and materially reduce the amount of employees they have to pay, then that should help keep profit margins high. And while AI could further push the world towards a universal basic income, as AI replaces a lot of jobs, even things like, maybe in a few years when we go to the dentist, it'll be a robot doing the work on us. The bus driver will be a robot. We could have robot cleaners, plumbers. It could replace a lot of jobs. And whilst that may not be good for a lot of people, it could actually squeeze the stock market higher and end up increasing earnings per share of many companies, and that's what the stock market correlates to more than anything over time is the long-term trend in earnings per share. However, looking at the other side of the coin with some bearish arguments is the billionaire stockbroker whom I've traded with for almost 20 years now, and that's Thomas Petterfy, who says a US soft landing is wishful thinking and the market should be much lower. He thinks the rally in the US stock market has been overdone. He also said he finds it hard to believe inflation will go down at the same time earnings will continue to rise. He doesn't see how with rising employment, inflation will go down. If there's a contraction in employment, then earnings will stop rising. And he thinks the market is going to go down pretty soon. And this is a guy with plenty of market experience. Actually first started on the options trading floors back in the 70s. And has built one of the most sophisticated, largest brokerages in the world, who I still think has the best technology and platform for online traders. Another bearish argument out there is Larry Summers, who's warning that Biden's economic agenda is increasingly dangerous and inflationary. He says it's wrong to suppose that manufacturing-based economic nationalism is a route to higher incomes. He took aim at the 2 pillars of Bidenomics, the shunning of free trade agreements that seek to lower trade barriers at home and abroad, and a turn to industrial policies that seek to foster high-tech domestic manufacturing in an effort to shore up national security and increase well-paying jobs. He argued that free trade agreements over the past 50 years have lowered costs for US consumers and helped create good-paying jobs at home, despite successful political efforts to tarnish these treaties as responsible for the loss of manufacturing jobs. The big earnings result we just got out after the bell was that of Microsoft, pretty much coming in line with expectations. They did see 27% growth in their Azure cloud business and posted fourth quarter net income of $2.69 a share compared to $2.23 a share a year earlier, with the CEO saying they're focused on leading the new AI platform shift. Their productivity and business unit, which includes LinkedIn and Office, was up 10%, and personal computing, which includes Windows and Xbox, dropped 4%. And just looking at the market reaction here, we did close up today 1.7%, but in after hours as I speak, we're currently down 4%. So the market might have been hoping for a bit more of a beat. However, it could be, like I mentioned last week after Tesla and Netflix, regardless of the numbers, it was going to get sold off anyway, as big investors may be using the liquidity surrounding earnings releases as a chance to reposition their portfolios. The other big one today was Alphabet, the owner of Google, doing a bit better and beating analyst expectations. They came in with second quarter net income of $1.44 a share compared to $1.21 a share a year ago, with their CEO also saying their continued leadership in AI and excellence in engineering and innovation are driving the next evolution of search and improving all our services. Their total advertising sales came in at $58 billion versus $56 a year ago. Google Cloud came in at $8 billion compared with $6.3 billion last year, and YouTube ad sales rebounded $7.7 billion from $7.3 billion a year ago. And just looking at the price action in Google here after hours, we are trading up 6.4% and doing a lot better than Microsoft. Overall though, we got the Nasdaq Qs trading off a little bit in the post-market. Another news out today, we had troubled regional bank PacWest rally 27% after hours after Bank of California confirms its plan to buy it. And a bit of crazy price action there, so they reported earnings today as well, which came in a lot worse than expected. The market sold it off hard 27%, but we're just doing a complete U-turn in the post-market here, up 34%. We also just got the International Monetary Fund's latest World Economic Outlook, and they just raised their 23 global growth prediction by 0.2 percentage points to 3%, and they're keeping their growth forecast for next year unchanged at 3%. They did highlight concerns of tighter credit conditions, depleted household savings in the US, and a shallower than expected economic recovery in China. They also expect headline inflation around the world to reach 6.8% this year, falling from 8.7% last year, and they expect the US economy to grow 1.8% this year and only 1% next year. And they also see Europe's largest economy, Germany, contracting by 0.3% this year, and that's led by the weakness in manufacturing, which is pretty much the case across all of Europe and much of the rest of the world as well. And we're also getting signs from the Chinese government they're about to do more to help prop their economy up and the property market in particular. And they're going to do that by ramping up policy support to boost domestic consumption. And this has helped give Chinese stocks a bit of a rally. And they're going to adjust and optimize their property policy to try and get a hold of their property market. And they're still trying to figure this whole capitalism thing out, as they've only really been doing it for 25, 30 years. Copying the Western model of economic freedom, free market capitalism, but still within a strange hybrid structure of communism and tight controls and preventing anyone from getting too big and powerful. And so the big news this week is the Fed interest rate decision due out tomorrow, 1 p.m. Eastern Time. Fed Fund futures are pricing in a 98% chance they will hike. However, the big one will be their guidance, outlook, and speak about whether they do another hike in September, currently priced at 21% by the market, or will they do another hike in November, currently priced at 34% by the market. And that's going to be the big thing that drives markets tomorrow, as the stock market is hoping there's just one more hike tomorrow and then it's all said and done for this cycle, and the stock market can keep cheering on inflation going down towards 2%, no more interest rate hikes, lower bond yields to contend with, less pressure on consumers and businesses with their borrowing costs, and going into that Goldilocks soft or no landing scenario. So we've got headline inflation at 3%, which isn't too far off their target 2%. So the argument is they only need to do one more hike. They don't need to go too aggressive to get that last 1% of CPI. However, we've still got core inflation at 5%, food still at 6 and 7%, and we've got crude and commodities back on the march higher, and still a really tight jobs market. So it's still yet to be seen whether inflation will keep just marching down in a linear fashion towards 2%. However, imagine he'll just keep saying what he's been saying for a while now, is that Inflation's still above their target. They're still data dependent. They just look at every report as it comes in, and a lot will depend on that CPI and jobs market. So I think they'll leave the door open for a September or November hike, but I think they'll also give indication that they could be done here if they continue to see inflation tracking down, and it'll just be the balance of that language, whether it's more dovish or hawkish, and that's how markets will react. However, looking at the VIX at 13.8 and tracking sideways over the last week, the market is not expecting any surprises tomorrow, so there shouldn't be any. And just looking at the government bond 2-year yield, that's sitting pretty flat as well at 4.88, and Fed Fund futures contract in August and September still tracking pretty flat as well, as we've seen volatility in the bond market decrease this last couple of weeks. So overall, there shouldn't be too much of a surprise tomorrow, and probably just another nothing burger of a day. I got some interesting charts I wanted to share with you here today. The first being US retail flows into stocks. That's single stocks plus ETFs. And we can see we had a bumper June, and it looks to be another bumper July again with inflows. And we're now getting back to those inflow levels around early last year, late 2021, just after the market had peaked. Here's another chart showing the 12-month forward PE of technology stocks versus the market. So currently, tech stocks forward PE is about 40% higher than the rest of the market, and that's approaching those levels we saw back in the late 90s, early 2000s after the last tech bubble. Actually got up a bit above 1.8. And just because tech in the overall market may be overvalued doesn't mean there isn't any value out there to be found. And one area of the market where you can still find a lot of good value is in small caps. And that's because small caps remain historically cheap versus large caps, trading at 20-year lows and 30% below the long-term average. We can see now the spread between small caps and large caps is 2 standard deviations below its average in terms of relative forward PE. And we can see that in a long-term spread chart of the Russell 2000 versus the S&P 500. You can see in the early 2000s, going into about 2013, small caps outperformed large caps significantly. However, over the last decade, they have underperformed significantly and down 35% relative to big caps, and look to potentially be putting in a big double bottom here from those COVID lows. And since we're in the middle of Q2 earnings season, here's a bird's eye view at the entire S&P 500 EPS growth out there. So we're expected to finish the season with the third consecutive year-over-year decline in quarterly earnings, and analysts are expecting this to be the bottom of the earnings cycle, with year-over-year growth coming in at -9%. Then we're expected to be pretty much flat for Q3, and then the market is expecting earnings growth to go positive again come the fourth quarter of this year and going into next year. And looking at the price action of the stock market, that is definitely what it's expecting. And so far so good in this earnings season. Nearly 4 in 5 companies have posted beats on what analysts are expecting. However, as we just saw, the bar has been set low at -9% overall. And so far, companies have exceeded estimates by an average of 6.2%. 78% of them have beat estimates, which is a little bit above long-term averages. And just looking at the earnings calendar this week, we've got a bunch more big ones coming out. Tomorrow before open, AT&T, Boeing, Coca-Cola. After close, Meta, Chipotle. Then into Thursday, Royal Caribbean, McDonald's, Enphase, Ford, Intel. And finally, before the open on Friday, ExxonMobil, P&G, Chevron, and a few others which the market will look to for a bit of insights into the economy and the consumer, and what all their CEOs' outlook are going forward. Just looking at economic data we got out today, not much from the US. We did get that consumer confidence coming in better than expected. That continues to trend up. Home prices decreased 1.7% year over year. Then in a few hours, we have some CPI inflation data out in Australia. Then going into tomorrow, we've got those new home sales and the big one, Fed interest rate decision. It was a quiet day in the options market, just over 33 million contracts traded, 56% of them calls. Little bump up in the dark pool index, but still diverging from the market. And nothing too interesting happening with corporate insider activity. And back into the charts, another day, another new high on the S&P 500, grinding up to 45.80 in today's session before pulling back a little bit. And the winner today was the Nasdaq having a little bump up after we had this 4-day pullback. And the loser was microcaps off almost 0.5%. And for my regular viewers and those who use my custom indicators, you'll notice a new indicator on my chart. These red arrows and green arrows as well. And that's my latest indicator called reversal signals, which is kind of a replacement for the DeMark 913 counts that I'd been using. I've created my own unique formula to attempt to measure spots where the market could be a little exhausted and ready to turn. And this indicator can be used on any market, any time frame. Primarily, it's built for the daily time frame. And in addition to the buy-sell bands and dynamic swing index, it's just another indicator we can use to help identify potential turning points in the market. And those of you that have purchased all 20 of my custom TradingView indicators as part of my indicator package will get this indicator added to their TradingView account tomorrow free of charge, because all future indicators I develop are included in my all indicator package for anyone who has purchased that. And I have some more cool custom indicators on the way as well, stuff you've never seen before. And these are all indicators I use myself to manage my portfolios. So I'm excited to share them with you guys in the near future as well. And just going through international stock indices, we see we're pretty flat here today. And there's that perk up from the China 50 index on the back of the news that they're going to do some stimulus to the economy and kind of tweak their policies and help out the property sector. And like I've had drawn on this chart here, the Chinese market has been squeezing up into this kind of triangle wedge formation and looks to potentially have broken out of it today. Over to volatility, like we just noted before, we're not seeing much of an uptick going into the Fed interest rate decision tomorrow. Market's not expecting any surprises at all. Breadth is still holding up pretty well, 87% of stocks above their 50-day average. Growth versus defensive sectors sitting at their 50-day VWAP. Getting a bit of a perk up here in commodities versus stocks. TLT continues to lose its 50-day VWAP. With that strength in rates, I do think we'll come back down into this support zone here. There's a look at the dollar index just above 101, and Bitcoin just trying to hold on above its 50-day VWAP. Continued strength in the commodity complex breaking out again, and crude still trading really strong, got up to almost $80 a barrel today. And continued strength in the agricultural commodities like wheat and orange juice, breaking out to another new all-time high today. However, we may be getting a little technically overbought up here. Over to stock sectors, we've got the cannabis ETF now back down into its all-time low support zone. Starting to look a little technically oversold. We can see we've got one reversal signal coming in today. We're still not quite oversold on the DSI, and the hidden divergence is still positive. So I'm still holding out hope that Safe Banking Act may go through, and that could cause a big pop in this fund. If not, hopefully the government does the right thing and legalizes next year, going into the election. But either way you cut it, this is a super volatile sector and fund, and it's always going to move around a lot. The winning sectors today were semiconductors, still hanging around in this big resistance zone. And the number one sector today was the materials sector, breaking out to new multi-month highs on good volume. And just looking at the weekly chart, we're not too far off all-time highs here. We also got energy stocks starting to perk back up again on the back of that price of crude. We're getting a few reversal signals in the financial sector and in defensives as well, healthcare and staples. Over to popular stocks, looks like BlackRock may be rejecting a little bit off this resistance zone. JP Morgan as well, although we can see on our range strength that there is momentum coming into the stock. So I probably wouldn't fade JP Morgan here. I still think it's walking the line and these reversal signals may fail. There's Apple calling up a little bit on an inside day. We've still got earnings 9 days out. Another quick look at Microsoft, trading down 3.3% after hours. And Google still doing well, up 6.8% after hours. Another bounce back in NVDA today, and Tesla just coming off a little bit. Bit of red out there in the meme space, with AMC coming off hard, and same with Nikola. Active today was General Motors, coming in with a slight beat. The market marked them down. General Electric continues to do well, trading up 6% today on the back of their earnings beat. There's more strength in the industrials with 3M up. Texas Instruments down 3.7% after hours. Also got earnings out from Visa, and not much of a reaction there. Spotify got slammed today after their earnings, down 14%. They increased their price and look to have missed estimates by a bit. And we did see a lot of weakness in the banks today in the regular session. However, in the post-market, we are still up pretty good here on PacWest on that news of the buyout, up 32%. It's also helping Western Alliance trade up 8%. Zion and First Horizon having little bumps after hours. And there's the big banks and Charles Schwab pulling back a little bit. Okay, that wraps it up for this busy earnings day. There's a lot going on in the market this week, and of course the big one tomorrow is the Fed J. Powell. But like we see in the volatility market, there is no surprises expected. He'll probably just come out and say we're data dependent, slightly leave the door open. He'll try not be too hawkish, not too dovish. He'll kind of just walk that line in between and remain neutral as possible and reiterate the US economy is good, everything's doing well, everything they've been doing is working fine, etc., etc. And so it looks like the march and grind higher continues. And that's it for today. Thanks very much for your support, and make sure you come back tomorrow for all my commentary and insight on what the Fed has said. Thanks very much, and I'll see you then.